Welcome back to How Would You Beat, where we discuss how you can use jobs to be done innovation methods to beat your competition and accelerate your growth. Remember to subscribe and like this podcast. In this episode, we'll look at ESG, which refers to environmental, social, and governance for companies. This has been in the news lately because BlackRock, the largest asset manager in the world, has adopted ESG principles in its investing, and there's been some backlash by opponents who, in summary, argue that investors should exclusively focus on shareholders. So the question is investing ESG principles a good idea or a bad idea? And can jobs to be done help us answer this question? So there's some big questions with ESG. Can including it in your investing criteria generate better returns? Or is ESG just a cost at the expense of shareholders? And another related question, is ESG a red herring or just greenwashing? So Jared, let's start with the fundamentals. What is ESG?
Sure. So ESG stands for environmental, social, and governance. So when it comes to investment, the questions become, how does this company handle environmental impact, environmental issues? How does it handle social issues? So what is its position towards the way it deals with employees, the way it deals with its suppliers, the way it deals with people in the community where it operates? And then the governance would be, how does it handle executive pay? What does it do to measure its impact on the environment and on society? And how does it generally maintain responsibility and accountability for the way it operates beyond the shareholder value it delivers?
Yeah, that's great. I think it's a good way to summarize, I think, is that there's lots of stakeholders around any company. And of course, famously, the example in economics is externalities. So, a company produces a product, it creates a lot of waste or pollution, and the company doesn't have to pay for that pollution or that waste, but some community does because it ends up in their backyard. And so the company really benefits from that. It creates equity value because obviously cleaning up the pollution would cost money. So their shareholders benefits while the community around them or wherever they operate or wherever they pollute doesn't. And of course, this is the big problem with climate change and carbon. There hasn't been a cleanup effort yet, and yet we are obviously putting out a lot of carbon. So the way to think about it, I think, is that it's all of these stakeholders. And I would also say what's just extraordinary is how important and how big companies are today for the world. Since 1980, there has been $100 trillion in equity value created by just public companies. So companies really are. I mean, and of course, famously, the large companies like Apple, Google, Facebook, Microsoft, et cetera, Amazon, are actually bigger than countries. Literally, they're bigger than some companies' GDP,
countries, yeah.
And certainly their market caps are bigger than a lot of companies.
And some of them probably
GDPs.
have more cash.
Yeah, they're just these unbelievable machines of capital creation. So we have to think about how companies interact with stakeholders. So the argument against it is that companies should just exclusively focus on creating equity value, and they should just do what they're doing and focus on shareholders, exclusively, and none of these other ESG principles. So let's use jobs to be done to kind of figure out is that a good argument or not?
Yeah, and one thing I would point out there is that there's often people think about ESG as the ethical thing to do or implying a certain morality. And to comply with sort of ethical principles or morality implies a value system. And so you're imposing the probably the operating executive's value system on the shareholders, right? And so you're saying like, in spite of whether or not this is going to be good for you as a shareholder, I'm going to do it because I think it's the morally correct thing to do and aligns with my value system of reducing environmental impact, et cetera. And that's, I think this is where JTBD can shed a lot of light, right? Because I think that once you say like, oh, it's an ethical thing as opposed to a market-driven thing, it takes your eye off the ball, right? You start to have this argument about values as opposed to whether or not ESG principles can actually help you make a better investment that produces a better return. So, good.
Yeah, no, I think that's great. And I think, remember, bringing in people's needs is fundamental. And we can map this out, which JobStudio helps us with, into functional, emotional, and consumption needs. So, and there are lots of stakeholders that a company interacts with beyond just its customers and its shareholders. So if you look at the needs of the customers and the shareholders, but also the employees, and also the local communities they operate in, and also just the global community of everybody, if you're breathing air on planet Earth, you probably care about what the air is like. So you can look at each of those stakeholders through this lens to say, what are their functional, emotional, and consumption needs? And is that something that we should help focus on in order to then create value for those stakeholders, but also to create value for our shareholders? They're not two separate things. They can come together very tightly.
Right.
And if
they
I
don't
remember
have to
this,
be in conflict.
They don't have to be in conflict. And I, if I remember correctly, I've thought about this a lot over the years. I think it was a few years ago. A shareholder who was, clearly opposed to a bunch of Apple's work, and I think he was complaining specifically at the annual meeting about their work for disabled people, like adding features for disabled people, which is obviously relative to the size of Apple and the number of customers is not a huge market. And Tim Cook's answer was, this is just the right thing to do. If you don't like us, if you're a shareholder, you don't like that we're enabling blind people and deaf people and handicapped people to really be able to use our products, then sell your shares, right?
Right.
And obviously Apple's in a big enough position that he can just, he can tell shareholders to leave if they don't like them. But what I thought is interesting about that is there is also an emotional benefit to Apple's customers that does go beyond the functional job. If you have a family member or a friend who needs those accessibility features, that's very functional for your family member, your loved one, your friend, whoever it is. But it's also very emotional for you, because if that's your child or your relative, your sibling, or a friend, having them really be able to get their jobs done makes you emotionally connected to Apple in a way that's very powerful. And that builds customer retention and customer loyalty, which is literally a metric that directly drives shareholder value. So, we focus a lot on the functional job, but there are these emotional elements, and that can extend through everything a company's doing in its communities.
I think that's super interesting. And just to take a step back, we talk about three types of jobs to be done, right? There's the functional job, which is the key goal you want to achieve. Then there's the emotional job, which is how you want to feel while executing the functional job. And then there are consumption jobs, which is what you have to do to use the product. So in the case of an iPhone, you have to unbox it, create an account in iCloud, set it up. There's a bunch of tasks you have to do just to use the product. And so what you're saying, which I think is very interesting, is that if we consider that all three of those jobs come together to create an excellent customer experience, that one of the emotional jobs you have when trying to get most functional jobs done is feeling good about the solution that you use, feeling like it aligns with your value system. It's not harming your friends and family in any way, right? Like to make it pretty real, like I can't think of a good example off the top of my head other than that, but I like this iPhone example, right? Which is, your friend or family member has a disability and they can't use the product because Apple's not looking out for them. That'll make you feel worse, and it'll hurt your customer experience. which then will make you potentially less likely to buy it in a competitive environment where there are other solutions that can get the functional job done equally well. So it's a competitive advantage in some ways to satisfy these emotional jobs and create a better customer experience, even though Tim Cook says it's the right thing to do and it feels only moral and ethically driven and about Tim's value system. As always a friend of mine,
Yeah.
even if you don't share his value system, you can see the business logic behind it.
Yeah. And it would be hard to measure the ROI on that, but maybe not. It's potentially measurable. Like what were people's views of Apple and their loyalty to Apple as a result of these features? You could take a stab at trying to measure that. And so his response to that shareholder could have been, "This is creating shareholder value. You just don't, because you don't understand it." And let me introduce you to Jobs to be Done to explain why this is important. And it is creating shareholder value. And that's what I think that Jobs to be Done can help bridge this gap between ESG and the functional market you're going after. Is it really can create shareholder value. Now, that's an extreme case where it's really emotional, but on the functional side as well, just looking at something like energy, let's take a really basic example like the energy markets or the market for oil, for example. And a lot of the controversy around ESG is companies not wanting to invest in oil companies. This literally goes back to the beginning of jobs theory and Theodore Levitt, who interestingly wrote about oil companies. This is in the 1960s. And he was trying to figure out how industries missed huge opportunities. And what seems like a very dated analysis, he was looking at how the movie companies missed the opportunity for television, which seems insane today. And then how the railroad companies missed the opportunity for cars and planes. And his third big example was, how did the oil companies miss the opportunity for natural gas? So, of course, the answer to all of those are no one wants a railroad, a car, or a plane. They want to get to a destination on time. No one wants a movie or a television. They want to be entertained. And no one wants oil or natural gas. They want energy. So one of the reasons to look at the market through this lens, if you're an investor, is to say, what is the likely growth in oil? And what is likely growth in alternative renewable energies,
right,
regardless of your moral position on either, and regardless if you think oil companies should pay for the externalities for the carbon they're producing.
Right.
Even just factoring those out, you just look at the economics, and the growth is obviously going to come in renewables. And I think you see this in the electrification of everything. And Tesla, we've talked about before, one of the great things about Tesla, what it shows is normally there was this trade-off between, doing something that was more like driving a Prius, which I did for a long time. It obviously was not a very powerful car, didn't go very fast,
Right.
didn't handle very well. It was this tiny little odd-looking thing, but, it was obviously sending out less carbon. So then you get to the Tesla. The Tesla is literally faster on every dimension. It's just a better car all around, regardless of whether it has gas or electric. And my favorite example is to try and prove how fast the Tesla, I think it was the S, how fast it really was. They raced a Lamborghini, but then they realized that didn't even demonstrate how ridiculously fast it really was. So they attached a U-Haul to the Tesla, and it still beat the Lamborghini while, having 6 passengers in the back and all your family stuff in your U-Haul, it's beating a Lamborghini. So those are such good examples of where the growth it's not a trade-off. There is going to be more equity value by considering all the stakeholders and looking at the job to be done. Is the future going to be about oil? I mean, we're not going to transition off it, overnight, unfortunately, but clearly if you're betting on innovation, like betting on oil might not be a good investment at all.
There's a company in Cambridge, Massachusetts called Commonwealth Fusion Systems. They raised a $1.8 billion Series B. And I find it hard to believe that investors are willing to put $1.8 billion up because it, aligns with their value system. Like there's a commercial opportunity there, and
Right.
energy is perhaps the biggest market ever, right? It's oil and natural gas, electricity created from solar and water and wind. Put those together, they are enormous market, trillions of dollars. And
Yeah,
so,
Saudi Aramco is the largest company in the world, I believe.
right. And so
Yeah.
if you have a path to disrupting that market, it's a huge commercial opportunity, no matter where you sit.
Yeah.
No matter what your value system is. And so I think one of the things we can talk about is there are jobs to be done that happen to be tangentially related to environment in the ESG parlance, right? So like the energy market is tangentially related because some energy causes damage to the environment. But whether or not if fusion is cheaper energy that you can get faster and from smaller, and then it's more profitable to get. If they crack fusion, it's going to be much easier to generate than it is to like create these complicated drilling systems that find oil in deep underwater wells or that try to extract it from sand. Right? Fusion is just a better product for generating energy, regardless of its environmental impact. So I think that's one category. I think there's another category which is really interesting, which BlackRock mentions in this story from Axios, that they think that taking the long view on what's happening in the environment will produce better returns. So what does that mean in jobs to be done terms? We often talk about the job doesn't change, the customer needs don't change, but what does change is which needs are unmet and the degree to which they are unmet. We live in a dynamic world, right? The world changes, new solutions come out, and the environment itself can change over time. And I don't mean just the climate, but I mean the world, the situations we live in, right? The environments around us. And that change can cause certain needs to be more or less met. And if you put blinders on against that, you can miss huge opportunities, right? If you say, well, it seems that preventing your house from sinking when it's on the coast is getting harder. Whether or not that's because of climate change and you believe in the value system or political position of climate change should not matter as an investor. It's getting harder to get that job done of preventing your house from sink. So you should figure out the investment opportunity and the solutions that are going to help people avoid that problem.
Yeah, I think that's right. And the problem with the politics of it is people try and draw this binary line. You're on this side or that side. And that's not what business is about. That's not what anything's about unless you're just being purely ideological. Right. But because business is about probabilities. And it is about the probability of, first and foremost, creating value for some customer. Who is the customer that you're targeting? And as you say, their customers have unmet needs. So what target segment are you going after? Which unmet needs are you targeting? And then factoring in everything that goes around that to be able to say, we've increased our probability of success or decreased it. And I think you're right that ESG, even the social and the governance side of it, like how do you treat your employees? How do you engage with your other stakeholders, the communities that you operate in? All these incredibly important factors in business success and business resiliency, which I think is another element of this, is how do you maintain yourself as a resilient business? Because companies are going off the Fortune 500 at a faster rate than ever before. So, and the S&P 500. So, you got to be, not only do you have to be resilient, you have to grow. Mm-hmm. So factoring in all of these things is incredibly important in increasing your probability of success and accelerating your growth and creating equity value. So this is why we of course, focus on creating equity value. If you're a company and you're not creating equity value, unless you're like a local small business and you own the business and you're generating a lot of cash for your family, that's great. But if you're even a medium-sized business and you've got employees and shareholders, you do have to create equity value. You do have to be growing. Otherwise, either you get beaten by your competition, your investors want to sell, or, the dramatic scenarios are where you go bankrupt.
Right.
So you do have to be creating equity value, but it's not a separate thing than all of the elements that go into ESG. And that's what I think we understand, especially when you're the largest investor and asset manager like BlackRock. You're talking about very, very broad trends in markets that you have to stay on top of, because you're operating at the market level. BlackRock's so big. I mean, to differentiate, than the S&P 500 is extremely hard at that size. So it's hard to do at any size, but it's certainly as you get larger. And I think they're doing something that I really recommend to any executive or entrepreneur, is thinking about the long term, because that is where job security is really powerful. As you said, Jared, the customer's job is not going to change. Now, there is a case where there could be new jobs that people have to execute, and that's regulations.
Right.
And so again, if you're assessing probability of being an investor and looking at what might happen with regulations, who can predict, right? We have crazy politics, and things get changed all the time. The Supreme Court just reversed, some EPA ruling. So that's crazy. But is it more likelihood that the world is going to see more regulations about things like climate change? The answer is yes. I'm sitting here in California. Again, the state is on fire. Overnight, we had this massive fire, just east of our capital here, explode again. It's literally looks like a nuclear bomb went off. It doubled in size, creating massive amounts of smoke again. I've been living through this for the past few years. Like that doesn't seem like it's going away anytime soon. So are we just going to sit here and do nothing, or are we going to respond to that with some sort of, again, probabilities that the politicians do something about this is extremely high.
Right.
Because people don't like when their houses burn down.
Call it climate change, or just call it frequent fires.
Right.
Either way, it's a problem.
It's a problem. Yeah, that's right. So I think they're looking at this long term, which is very smart, because the jobs are there, they stay, and the new jobs that will have to get executed are compliance. And by the way, this is what happened in 2008, right? After the financial crisis, we had gotten rid of all the regulations. We basically repealed Glass-Steagall and said, okay, AIG, you can go create this like fake insurance company with no assets that's totally unregulated, and then you can help contribute to the collapse of our entire global economy. And then out of that, Dodd-Frank was enacted to say, wait, that was a really dumb idea. Right. We need some regulatory boundaries on these financial markets. So that happens. The response to those types of collapse and changes are, okay, we need to play the game differently. We need a different set of rules, because it didn't work. I mean, it literally brought the entire financial system, to collapse, which nobody wants.
Right.
So that is the long-term game. And I love the Warren Buffett quote when asked why more people don't imitate his investing style, and he said, because no one wants to make money slowly. And I always love that, because you should do things oddly slower. I mean, everybody wants to develop the next thing and ship the next feature and get out, as fast as possible, obviously. But the slow element is that if you really are focused on your customer's job and your stakeholders' jobs, all these other stakeholders that are your employees, your investors, your board, your communities you operate in, even the politicians that you have to interact with, all of those stakeholders have jobs. They're trying to get them done, that are independent of any solution, and you paying attention to them, certainly when you're as large as BlackRock, but even if you're a medium-sized, company, these types of things can have a big impact on your business if you don't pay attention to them and make yourself more resilient as a result.
Yeah, so I think we've gone through a few categories of opportunities that are related to the ESG discussion. So we've got jobs that are fundamentally ESG, environmentally based, like the energy market. Innovation in the energy market can create huge commercial opportunities. We've got emotional jobs that if you appeal to certain social stakeholders and satisfy emotional jobs, you can improve your customer experience and generate growth. We've got compliance jobs, which, because the government is creating new regulations, cause a job to come about. And that relates to governance because you may then have to report to the government or your stakeholders about how you're doing against that compliance, which creates opportunities for new technology platforms. And we're seeing large investments in this space right now because there's going to be a new job to be done that's going to be very hard to get done. We're seeing the environment can change, causing unmet needs in existing jobs. And so we need new solutions, and there are new opportunities there. And I think the last one you just pointed out, which is, think of the social in ESG as how you treat your customers and do you deliver value to them or not. And that's kind of jobs to be done 101, right? If you deliver customer value, you can win. And I think of, this is a fictional, well, it's actually based in a true story, but The Wolf of Wall Street, the movie based on the stock trader, he was abusing his customers, right? Like he was getting them into bad deals where they lost money. And he made a lot of money very fast, but then imploded. And if you follow jobs to be done principles of creating customer value, doing well by your customers, and having a revenue model that aligns with them getting the job done better, and as they do well, you make money, and if they don't do well, you don't make money, that can prevent situations like that. And it's, the Wolf of Wall Street is an exaggeration almost. It's almost hyperbolic how crazy that is. But you can see this happen in much larger companies. I think Facebook is an interesting example, right? The connecting you with your your weak social ties better is a job to be done that makes sense. Addicting you to their app so that advertisers get more of your attention can be in conflict with better connecting you to your social ties. So the revenue model and the job are in conflict. Now, that doesn't cause them to implode overnight, like getting clients into bad trade deals like the Wolf of Wall Street does, but we're seeing the cracks in the armor over time. And I think that's related to the slowness you're talking about, right? If you're not taking care of delivering value to your customers, the S in ESG, right? The stakeholders are your customers and the social aspect, that can come back to get you sooner or later.
Yeah. Yeah, because everybody's competing and there are competitors. And if you're not aware of who's going to get the job done better in your market, that's a huge problem. And frankly, that's what you see with the oil companies. They do a lot of greenwashing. There's no doubt about that. But, have they really taken the step to say, we've got a plan to not sell oil anymore? Now, that seems insane. But that is I guess we'll call it the insane question. It's the most important question. Like, can you envision a future where you're not selling your current product? Because this happens in every single market. If, obviously we use Apple all the time for this example, but 50% of the revenue was the iPod. It is now 0 because instead of keeping with the iPod, kind of like the Sony Walkman, right? Sony was like, we have the Walkman, we're going to sell cassette tapes. And then they tried to make a disc version of it. It just didn't go well. And then they just lost out. Like they didn't even create an MP3 player that had any success, right? Mm-hmm. So they just I haven't bought a Sony music device for forever. I mean, I actually still have some headphones I love. They've been making these same headphones forever, but literally Sony was a brand that I, as a teenager and in my 20s, Sony was the Apple brand of the day for audio, right?
The only time I hear about them related to music now is in publishing.
Yeah, I mean, they just lost the market because they were focused on their product, not the customer's job. There was enormous opportunity for innovation, obviously, and so you really have to envision a future where your current product doesn't exist. And obviously in some markets, that's going to be a long time from now. Software is, a pretty stable market because software is, very, very valuable. And, but even in that case, even in software's case, you have to think about it like, will there be a way that the software does this for my users rather than having my users do it? And back to music, that's a great example. You used to have software that you would find songs and buy them on your computer. You'd sync them up to your iPod, and then you have to download them. Now that's gone. Now the software does that for you automatically. You just click on a song and start listening to playlists, right?
Right. It's interesting to think about if there are protests against your product, what does that mean
Yeah.
about unmet needs you're not satisfying and and the need for you to innovate, right? Not every protester is right about everything. It could be maybe you are doing the right thing, you just need to communicate it differently. That would be great. But it's worth taking a minute to say, like, okay, if they are right, what unmet needs aren't we solving that somebody else might better with a different product? And that exercise can be worth a lot.
Yeah,
it's just one signal.
It's generally a indication that there are externalities. Something's happening with your product that people don't like that isn't your customer value. It isn't your delivery of customer value. And remember as well, a lot of these, if you look at the businesses and what they're fundamentally doing, they are also in extremely cost competitive businesses. So energy is a great example. Energy is a pure commodity. That is just a unit of energy. A kilowatt is a kilowatt is a kilowatt. An electron is an electron, right? So when you're competing in those markets, you also have to watch what's happening to the cost curves, because people will always pay to get a job done faster and more accurately, but they would happily pay for a lower cost solution that does the same thing. And that is such a good example of where the oil companies are just not fully understanding the impact of where the cost curve that alternatives and renewable energy are on is going to just keep them from sustaining their business. And it's already happened, right? You know, it's just cheaper now to build solar than it is to build, you know, a new coal-fired power plant. Now, you know, solar has drawbacks and there's all sorts of other issues, obviously, but you have to pay attention to that, because it's the speed and accuracy of getting the job done combined with the cost to your customers to get the job done. And no one wants to pay more for energy. It's a tax on everybody. So you want lower taxes, right? And so as soon as those lower price solutions come into your market, you're likely to lose share quickly.
Yeah. It's kind of interesting as we're talking. I'm thinking that, you know, if you're criticizing companies that are including ESG as criteria in their investment strategy, you really run the risk of your own value system getting in the way of opportunity, right? I don't want to invest in that because it's green and I come from oil country. Right. Oh, right. Okay. Preserve your product. You know, that worked out really well for BlackBerry and Kodak. Let's see how it works out for you in the long term. It's just like, you know, and it's a high stakes. I get that. Oil's not going away tomorrow. So if you're in that business, you know, make the sales you can, but think about how you're going to survive in the long term.
Yeah. And it really is this long-term perspective. Obviously, you know, we work with CEOs and executives who have this long-term perspective. We're not helping, you know, day traders. If you want to trade on the market going up and down and play that casino game, you know, have at it. But it's really, that's the difference between trading and investing. Investing is figuring out what is the current value of the company given its growth rate and its future cash flows. Owner's earnings, as Buffett calls them, and you have to discount that back today. So the huge driver in that valuation analysis, if you're investing over the long term, is that growth rate, and which is a function of whether or not you'll continue to create value. So if you said, will everybody drive an internal combustion engine car forever? The answer is no. I mean, California is already going to regulate them out of existence. It's clearly their electric cars are already just better. They're just
I was going to say, even if they didn't regulate them, I wouldn't buy one as my next car.
It's just faster.
Cars are quieter, faster, more comfortable. It's nicer.
Yeah. Yeah, I mean, I like to go fast. The Tesla is very fast.
Yeah.
It's fun. So, yeah, I think that, you know, the writing is on the wall because it's getting the functional job done better, regardless of the ESG principles, right? It's just getting the core functional job done better. So if you're taking that long-term investment strategy and outlook, and, you know, we talk about this all the time, in any of these valuation and investment spreadsheets, you can type in a different growth number and you look like a genius, right? Whether you're buying a company planning a roadmap, investing in a public stock, anybody can take a spreadsheet now and create that valuation model and say, look, I'm going to change the growth rate from 7% to 15%, and I'm a genius, right? Well, okay, how do you change that growth rate, and what's the likelihood that that growth rate continues? Because that is the discounted present value of all those cash flows that creates the valuation. So you need to know what that growth rate is going to be. And if you're not looking at the customer's job and all the competition to get that job done, then you're likely going to have an inaccurate assessment of that growth rate, which lowers your probability of success. So that's where Jobs to be Done can really give you a lens into ESG and markets and stakeholders, and is the company that you're investing in or buying or running, is it really likely going to sustain its value and grow?
Right. I think it's a great place to end.
Yeah, great. Well, thanks for listening. Remember to subscribe and like to this podcast. And if you want to learn more about Jobs to be Done innovation methods, visit us at thrv.com.